All right, we got just under 3 minutes until we are going to get things going for the first stream we've had, I think, in a couple weeks. I've been traveling and have not been available, unfortunately, on Sunday nights, but we are back. We've got fridge opener breaking the seal in the Twitch chat. What's going on? We love to see it. Minute 30 until we get things underway. All right, 5, 4, 3, 2, 1, and we are ready to get going. Let's X out of the notification. I think we're there's the notification off screen. Okay, and now we are good to go. So happy Sunday. Welcome to the weekly stock. Well, I guess calling it weekly at this point might be a little sketchy because I think I've definitely had some busy Sunday nights recently, but happy to be back on talking through this with you guys. And we definitely have a lot to talk about, a lot to catch up on. And the good news about this stream is, sometimes I feel like our streams are more so just, coping sessions and support groups because sometimes the market can get a little rough. And, I feel our job is to step in and say, things are going to be okay. And we say that when things are bad because this is what they look like when they're good. We made $3,601 in the market last week and was a little bit bummed I couldn't stream last week because the week before we made $10,709 in the market for a 2-week total of roughly $14,000, which is fantastic because over the same time frame, the S&P 500 only really went up 1%. So gaining that much ground in what was a flat-ish period for the S&P 500 is definitely huge for us as we move towards accomplishing our overall goal, which is long-term outperformance of the S&P 500. And to contextualize that a little bit, we'll flip over to our performance since Inception tab. And again, all of this that you see right here on our profit tracker is publicly tracked, and you could find it in the profit tracker channel of our Discord server for those of you that are in there. Here we are. We are the blue line, the HT line, which is far above NASDAQ and the S&P 500. We've been having a really a tough year so far, but we are outperforming overall in the year, and it's been since around the beginning of May is really when I would pinpoint when we shifted our strategy a little bit, and we've seen some very good results as we've shot upwards despite what is a relatively decent decline or a continued downturn in the respective indices that we've seen. But we're outperforming NASDAQ by over 100%. We're coming up on that mark for the S&P 500. Things are going great for us right now, and we're coming off a decent streak, right? If we add up everything since May 8th, not including this because this is what we've got next week, which we'll talk about a little bit later in the stream. But since May 8th, we've made $25,938 of profit as we've ripped upwards to now outperforming both the NASDAQ and S&P 500 just on the year. And for those of you who have been following us throughout the year, you know we've had a terrible January where we dropped $39,000 in the first 3 weeks of the month. And we've been trying to get back on track. And, you know, that hole off the bat is what we've been trying to recover from. But from that point, we're actually very green overall, right? From that point, we've taken home a profit of $16,000. Where over a comparable period, right, this January 23rd point, the S&P 500 was at 437.98, and it now sits down at 385. So a huge decline for the S&P 500 over that period, and we've been crushing it over that period. So super happy to report that. And one of those things where, yeah, the yearly number still is negative, and we're going to continue to work to try to get that to a positive number. And I definitely believe, you know, only being at the halfway point of the year right now, that we can absolutely get that to a positive number by the end of the year. But the big mistake this year, we've said it a million times, is our position sizing on Roblox and Affirm off of the bat, and it absolutely crushed us. But we've adjusted. When we make a mistake like that, it happens, right? We had the mistake back in October of 2020 with Hyliion, where we went from a 50% gain in our account and we went negative briefly. But despite that big mistake, right, we recovered, we adjusted the strategy. We had another big mistake right there with Roblox and Affirm, but despite that mistake, you know, you learn from it, you recover, and you continue to execute at what is moving forward a better strategy. And we've continued to do that. So despite two big mistakes over the time period that we've been publicly tracking our trades, which is now over 2 years, despite two big mistakes, we are firmly outperforming the overall market. So very happy with what we've been doing. We're going to continue to try to execute on that. So before jumping into what we've got for the next week, and I think we've got some interesting opportunities, I should say, for the next week. Because if we scroll down here really quickly, we don't have a lot of trades in play for the next week. So we'll definitely be a little more focused on research for this coming week. But if we look at this on like a line-by-line scenario, right, there really wasn't anywhere that we lost money during the week. It was as close to a perfect week as we have been in a long time. Now, the MLFB, I'm going to kind of ignore that because it's just some crappy penny stock that we own. And just in case it goes up a ton and we make a bunch of money, I want that on the ledger. But I'm not going to spend too much time talking about that because I definitely don't want any part of that holding to be interpreted as a stock market pump or anything like that. But moving down, right, a great example of scaling into trades. Excuse me. And we've talked a little bit about this and why we like to do it and how it's so effective. Right, for example, our initial trade that we had going into the week was an Affirm July 15th expiry 22 strike put that we sold for 95 cents. We know that our break-even price on that is going to be the 22 strike minus the 95-cent premium to give us a 21.05 break-even price on Affirm, which in and of itself was fantastic because I believe Affirm was at 23 going into the week. So you get a roughly 10% cushion on Affirm, but as things typically happen and tend to happen in the market more often than not, you know, you're going to be surprised. Affirm had a very, very sharp drop and dropped to the point where we were able to sell 20 strike puts on it for 85 cents. And that's the idea, right? We talked about how our big mistake at the beginning of this year had to do with us sizing in way too large on an Affirm and Roblox position where we had 15 contracts, where our adjusted approach that we're now using starts with 5. If things are bad, then we add 5 more. And if things get really bad, then we add the final 5 to work our way up to a full-size 15 contract position, as opposed to having 15 contracts off the bat. Something goes terribly, you know, and then we're in a lot of hot water and we don't really have a lot of flexibility. There's no real way to play defense. By scaling in, going 5, 5, 5, you know, dividing your total position size into, you know, thirds and targeting a little bit higher of a return off the bat, right? We know we typically like to target a 1% ROR on a weekly basis. But if you look at what we have right here, we have a 22 strike paying almost $1. That's a hair under 5% ROR. But if we have 1/3 of our position pulling 5%, that's better than 100% of the position pulling 1%. So I think that approach to the math behind some of these entries is something that we're going to be sticking to moving forward. Because as you can see, the initial max profit that we had on this position was really only about $475. Yet even though Affirm dipped, we added more. And we actually ended up with more. We ended up with $810 on a position where the initial max profit was only $485. So you kind of get some value in that as well, in the sense that if it dips and then rebounds, as a lot of stocks typically do, you're able to catch that dip, scale in further, and then catch the benefit of any subsequent rebound. So that's exactly what we did. Similar idea with DraftKings, where we scaled in with a half-sized coverage triangle because we sold 10 of the 11 strike puts as opposed to 20 of them. Just to err on the side of caution, because things can always get worse, and that's something we absolutely want in the back of our minds as we navigate through this tough market. But with that said, we pulled an additional 250 on that. The DraftKings stock got down. It was pushing 11 at one point, which is why we opened the 11 strike put. But you trust the process. You add when it's smart to add. When the market and your watch list look red when you're opening your brokerage screen on your desktop or checking your app, that's when we go shopping. We want to make sure that we have a decent bit of capital on the sidelines at all times on the front end of a week, so that if disaster does strike or we do see a red day, which we have seen a lot of lately, instead of it being a moment of panic, it's more of a moment of opportunity. And that opportunity really is best illustrated by the fact that you can see in column G here these trades that we tag new with the purple highlights. If you add those up, those new trades, those trades we added during the week where we saw opportunity, those equaled $2,568 worth of profit. So if we had just gone into the week with what we had heading into Monday, we would have made $1,100, which is always respectable to make money when the stock market is red overall. However, by keeping some cash on the sidelines, giving ourselves the flexibility to enter into something like a firm, something like adding these DraftKings 11 strike puts, scaling into Open Door the way that we did, continuing our SPX 0-day strategy, adding things like TTD and shop as the week progresses, that is where a lot of our advantage comes from and why we like to have the flexibility of keeping so much cash on the sidelines. So that's exactly what happened there. Moving down to Open Door, very similar story, right? We sell a 5.5 strike put for 25 cents a premium. We have an initial break-even price of $5.25. But oh no, Open Door goes down to $5 a share and we're looking at a loss. However, that's when we deploy that extra capital that we had reserved. We sell a 5-strike put. That's an additional 25 cents a premium and is a direct reduction to our weekly cost basis. So we went from $5.25 down to $5 on the dot, and Open Door ended up at like $5.09. So we made $90 on that, despite the fact that the stock went down about 7 or 8% on the week. So anytime we could pull profit while the stock is moving against us, we are thrilled because we know exactly what it looks like when the stocks move with us. Further down the list here, really similar ideas. CLF, I'm going to talk about this for 2 seconds just because typically we would roll this position into the following week. However, CLF has earnings, I believe, this Friday, so I want to stay away from that. Just avoid that earnings risk. But Zim, 43 strike put, $282. Take that to the bank. MSOS, 160. 210 on Ford. I mean, these things are just really nice. We had nice cushions going into the week. And one of those weeks where, the market went down, but it didn't go down enough to put us in a position where we were going to lose any money. And that is, at its core, why we love this strategy so much. Because even when the market's down and markets are volatile, sometimes that acts as an opportunity for us. The Mara spreads we started with these initially for 20 with the max potential profit of 200. Yet, we made 250 on it this week. And why is that? Because when Mara continued to move against us, we used that some additional cash that we had on the sidelines to open an even higher spread. Got out of that for 150 profit, got out of the original for 100, and all of a sudden you got $250 on a trade that if it went perfect off the bat would have only been $200. And that's the advantage of having some cash on the sidelines. And I know I sound like a little bit of a broken record, but this type of approach is, I cannot emphasize how important it is. And it's really what we have been relying on since May. And that's the reason why you see our chart kind of go on a really, really nice run since the beginning of May, especially when compared to the S&P 500 and NASDAQ. Moving down the list here, not too much else to talk about. The SPX 0-day spread strategy has been going beautifully. We actually started to track it here, and we're at $6,820 of profit since we've been putting that into play at the beginning of May. So that, over May, June, July, 2.5 month period, we've pulled about $7,000 of profit. If you want to, lay that logic out over the course of a year, that's going to end up being about $25,000 or $30,000 of profit if this keeps up. And I love the math behind this. We wrote out a post on our blog on hourglass-trader.com. So if you're curious about the strategy behind that one, pop on over to our website. But really nice expected value on these trades, and I think they're very, very easy to execute and systematically just take emotion out of the picture and just stick to the script. FFIE is really kind of the only one that I maybe regret because it did get down to 29 cents at one point, which would have been $140 of profit. But at the end of the week, as you could see over here, where is it? I don't think it's on here. But it jumped back up right around 750. So we're at a temporary loss, right? The potential max profit off the bat was 430. With these spreads, though, and these volatile names that we play a lot of the time with these IV reversion stocks that we get in our get alerted in our Discord server, I think they're very profitable opportunities, and we've proven that with what we've done with Mara, with what we did. Let's see, FFIE. The week before, right? We had two identical ones that we got in, got out, got in, got out. $392 of profit, perfect. GameStop, got in, got out the day after, $164 of profit. Like just those three right there, those quick ins and outs, $556 of profit. So there's a lot of money to be made there, but I think it's smart to potentially take a little bit more active of an approach towards those. Time the ins, time the outs, and I think the biggest thing is just don't get greedy, right? If you're playing a fade and the stock fades and you could take like 30-40% of max profit in one day on a trade that normally would have taken a little bit over a week, you absolutely do that. Staying conservative and not getting greedy is going to get you a long way in the market that we see right now, because something could look one way on Tuesday and by Wednesday morning it's an entirely different landscape. Things are changing in the blink of an eye at the moment in the market. But moving down, Shopify, I really liked that opportunity. The trade desk, I think there was a red either Wednesday or Thursday in the market last week. I don't know. It's been a few days. I forgot the exact entry. But again, we provided some volatility and provided some very conservative strikes that we were able to sell. And right there, $438 of profit. Fantastic. SoFi, really similar idea as Open Door, as CLF that we talked about, where we scale into the trade like we did with the firm. We initially sold the 6-strike put for 13 cents a premium. We know that would set us up with a 587 break-even price, and it got down to 587. So we said, okay, we're just gonna sell the same thing for twice the premium. And by the end of the week, SoFi had gone back above 6. So our initial trade that only had a max profit of 130, because it dipped and because we were able to take advantage of the dip, because we strategically kept some cash on the side for that specific move, we ended up with $390 as opposed to that initial 130. And these are the types of moves, right? We talked about it a second ago, where our new trades that we entered into during the weekend alerted got $2,500 of profit for us. That is where a lot of the opportunity lies in the market, the way that it is currently trading, these intra-week entries and exits. But with that said, really nice week, $3,601 of profit. Again, that's a 2.34% return. But it's particularly impressive when compared to the S&P 500 return, which was a 0.92% loss on the week, and therefore we outperformed the S&P 500 by 3.26%. Continuing on the really, really nice run we've been on since the beginning of May, where we've taken home a profit of just over $20,000 in 2.5 months, and we really don't see a reason that we can't continue that, right? Because sometimes we'll have pops on a weekly basis just because the market flies. That happens, and we are happy to be the beneficiaries of that, because in the end, we do have a lot of neutrality with our strategy. We do have a lot of downside cushions, but at the end of the day, if the market's going up, we're going to make a lot of money, and it makes it a lot easier on us. But with that said, you could see the red line here, the S&P 500, the yellow line right here, NASDAQ, from the beginning of May. They're both down decently, and I believe the number is about 6% over that time frame that we've made 20K. So make no mistake about it. What we've done, I think, is largely more attributable to a slight adjustment in our strategy, as opposed to us just getting lucky because the market's going up, because it's not really going up that much. If you go back to the beginning of May, if you bear with me as I scroll through this maze of a profit tracking spreadsheet, right? If you go back to the beginning of May, DraftKings was trading at 1368, right? 1315. And if you go to today, DraftKings, our largest position in our portfolio, is all the way down to 1230. So it's down, right? You'd think if we were pulling these really nice returns, it would be with an assist on some of the stocks. And I'll be the first to tell you, a lot of the stocks are still not really cooperating with us. It was great the week of July 3rd. That was fantastic. Honestly, that's what it looks like when stocks cooperate. But, we're still hanging in there, because we never know what's going to happen on a short-term basis in the market. We want to have our downside risk covered, but we're pretty confident that in the long run, the market is going to go up. So we hang with it and, deploy the strategy that we deploy in order to continue to protect ourselves and, just not blow up in case things keep going down. And in some cases, still make money when things go down. So really nice week, and that takes us to what we've got for the coming week. And you may notice, as compared to some of the other weeks that we saw as I was just scrolling up and down the profit tracking spreadsheet, this is a very, very light week of holdings. And I think the last time we had a so-called light week of holdings going into the week was this, and it was for the best because the market was down a lot that week. And it's best to tread cautiously sometimes. You could kind of be lulled into a false sense of security a little bit when you start to see a little bit of green, as we have over the past few weeks, but we don't want to let that make us complacent in the market. We still want to be cautious. We still want to be in a position as far as free cash is concerned, where if the market drops 2% on Monday or Tuesday, or keeps tanking on Wednesday, we're not panicking and managing margin calls. We're adding more to our positions. And again, if the market goes up and none of that ever happens, we don't even break a sweat next week, and we pull probably a little bit more than $3,300, which is always going to be a successful week because that's over a 2% return for us. So that's been going really, really well. Well, let's take this thing top to bottom, right? We've got to firm the 22 strike puts, exactly what we talked about a second ago, right? We don't want to start with the full 15 size, and we don't even want to start with half, with like 7 or 8. We want to start with 1/3 size position. We can kind of walk back through the evolution of some of these Affirm trades over the past few weeks to show an example of why, right? Because, for example, Affirm went really well on the week of June 19th. We made $655 from it. Just the five contracts, right? Just 1/3 of the position. We took home $655. I'm never going to be mad at that trade. That's fantastic. But the next week, Affirm doesn't do quite as well, right? We whittled our break-even price down to $18.83, but as you can see, the stock went from like 22 down to 17, which is a enormous dip for a 1-week period, but it does happen. So we started with that initial 5 position, and yes, that position did lose money. That's going to happen. We averaged in with some 19 strike puts. Those got breached. We averaged in with some more 18 strike puts, and once we had all 3 legs of that trade in, we're fully in. From that point, we let it ride and accept the fact that the stocks dropped a bunch. We've set ourselves up with an advantageous break-even price, and we wait for the rebound. Because if you look at our year-to-date summary, a lot of what happens is we do have big weeks sometimes, but the idea is, or I guess the theme is, that they're normally right after really bad weeks. And the way that our strategy works is that's typically how it happens. So the change in approach we had at the beginning of May was to say, hey, we know that these weeks are probably going to happen, these big 14, 20, 23K. So let's carry a little bit lighter portfolio, so when that price action that normally would cause that 23K loss happens, we could scale into what would be a full-size position, so we don't get the entire detriment of the big loss, but we still get the full impact of the big bounce. And that was very, very well executed when we saw what happened just in this week that we were looking at, right? We lost $6,900 in this week that we were looking at a second ago. But again, let's see how much of that. 2,600 of it was with Affirm, but we scaled fully into Affirm, and we just rolled the entire position into the following week. And just like that, even though we lost 2,610 the previous week on some terrible price action, we made 2,400 right back because it bounced back above 18. And if we had kept the thing a few strikes higher, we would have made a killing on this. But again, the idea is never to get too aggressive. But we took those concepts and applied them similarly across our entire portfolio. So in a week where the market and price action was down a lot, right? DraftKings went from 14 to 1177. Cleveland Cliffs went from 1648 to 1576. You get the point. We didn't get the full detriment because, as indicated by a lot of these new tags, we scaled into these positions as things got bad. And yes, the damage was tough that week, but as we scaled into and kept the full size position, rolled those positions out a week, all of a sudden you've got a 10.7K gain the next week. And while you have still the market's red, right? It dropped 2.27%, bounced 1.95%. That's not fully recovering. The market's still red. Yet we still netted 3K profit between those weeks. So that's the idea of what we're going for with these smaller positions. So I wouldn't necessarily interpret these smaller positions as a lack of confidence in the market, but we always do want to keep that macro perspective of the S&P 500 in the back of our minds. And normally off a red week like this, minus 1% is not really that big one way or another, especially with the volatility that we've seen lately. But one thing we do want to keep in mind is last Friday, if we could take a look down here, the S&P 500 was up 1.91%. It was a very bloody week before what happened last Friday. And, for some of you guys who seems like we've been running into a wall over and over and over in 2022 by just getting eviscerated by the market on Fridays, it's fantastic to finally have one go our way. And it ended up being a really, really nice week despite still being red overall. But again, yes, the market was red, but it also just came off a plus 2% day. So we want to kind of reconcile those two ideas in our mind. And for that reason, I'm still pretty cautious. We could pop open the 180-day RSI to kind of further move this idea along of where we expect price action to go in the short term. And RSI is sitting at 61, right? So because of this little, recovery that we saw on Friday, if you want to call it that, even though it didn't fully recover the week, we're still above 50 on RSI, meaning the market is overbought. And RSI is all over the place. You've seen what the market looks like. What goes up must come down, and what dips too hard must come back up sometimes. But we're not really in the red like we are sometimes when we get very concerned, and for good reason, because last time we were in the red, fell off the face of the earth. Last time we messed around with the red a little bit as well at the back end of June, another big red candle. But this is why we love RSI, especially on a 180-day basis. It's very useful for trying to gauge what's going to be happening with the market. So with that in mind, 61 RSI, we don't really need to get too aggressive one way or the other. So that conservative, since it is slightly overbought, that conservative approach, I think, is going to be the way to go. So with that said, we could finally get back down the list. I think I've started talking about this several times before going off on tangents, which I think are important, but let's get into it. We've got these 5 that's going to pull $550. And again, the idea is instead of going for 1% ROR per week with the full position, which is what we normally like, we love that because it annualizes to a very nice number, and you're going to do very well if you could pull 1% per week. But we start with 1/3 of a position and about 5% ROR, which comes out to being a better return than having a full position and for 1% ROR. So that's what we got, $550 right there. DraftKings, since we cut the position short yesterday, I guess we rolled our calls Friday. We rolled our calls on Friday when DraftKings was at 12:30, and it ran from 12:30 to 12:86. So we're already looking at a little bit of a gain there that's going to be counted for next week. So that's looking very, very nice after that run we had on the back end of Friday. And again, it's capped out at 13, so there's maybe 14 cents, which is going to be $280 more potential of profit. And if it goes up, it goes up. I'll happily take $280 more plus the $520 of call premium for like an $1,900 gain in a week on DraftKings. But if it goes back down, happy to do exactly what we did last week, right? Take advantage of the capital that we have on the sidelines, leg into a strangle a little bit, and maybe throw $250 more of potential profit on the table. Open Door, same deal. And this is actually a new cycle of Open Door. Is it? I may have just lied. I think I just told a lie. No, this is still a continuation of the old trade that we want to, that we're going to want to keep up here. SoFi down here, cutting to the bottom, is a new trade though, because those previously both expired worthless. And SoFi is a fantastic trade that came to a conclusion last week when those, I haven't even added the last ones yet. It's better than I thought it was. So if we copy both of these over really quickly, throw these right here, drag these down. There you go. This SoFi trade was fantastic because over the life of the trade, right, it finished at 619 last Friday, so we let those things ride. But over the life of the trade, we started in SoFi when it was at 935, and that was back on April 1st. So it has been 3 months, but over the course of that 3 months, we ended up making $1,000 on SoFi, despite the fact that the stock has dropped over 33% in a 3-month period. And if you're able to put yourself in a situation where a stock is dropping, it's getting its price cut by 1/3, and you're still making a nice return. Again, this return that we're generating on this capital annualizes to over 100%. So if we did this every single week, we would double the money in our account. And again, that's assuming you use your entire account, yada, yada, yada. But just to contextualize how impressive a 20% return on a trade over a 3-month period is, that's over 100% a year. That would be doubling your money. And best of all, we've done it during a period where the market and this stock specifically have slid. So that's the value in identifying high premium opportunities like that. And again, going back to the idea we've been discussing over the course of this stream where you scale into trades, right? You'll notice we started with 10. And then you'll notice in the second line, the note that we have right here is there was a big dip. We added some 8-strike puts to reduce the break-even price. And when we initially got in, the stock was trading at 935. Our initial break-even price was 879. But over the course of 3 months, we were able to get our break-even price down below, or down right around 5 a share, which is a significant reduction over a roughly 3-month period. So that was a great one that kind of came to a conclusion. We're starting right over, right? You start with exactly what we did last time, sell 10 of them. If we win, we win. It'll be 130 bucks. I could do something, have a nice dinner with that. Who knows? Fubo we also got back into because it was dipping pretty hard on Friday, I think, and that premium's good enough for me, right? 13 cents a premium on a 2.5 strike put is a roughly 5% ROR. Happy to start there again. That's another 30, right? That's how you start stacking these trades up one by one by one. MSOS, this was one that we actually discovered when we were running some scans a couple weeks ago, and it's kind of been a bit of a gold mine for us. Assuming it finishes above 10.5 this week, we have this. Last week it expired worthless for us for 160. The week before that, I believe we actually ended up being assigned on shares of MSOS, but we sold puts before that. We were assigned the shares. We sold covered calls, yada, yada, yada. But over roughly a 3-month period, that one has made us $710. So despite the fact that this one really hasn't done too much either, it stayed kind of in this 1050, 1150 range, we were able to identify some really nice premium on one of our option scanners, and that's the value of having a good, scanning strategy going alongside with your stock picking, because you can identify really good opportunities like this. But we spent 10 minutes in a scanner and we found a trade that made us $710 over a 3-week period. I think that's pretty good. I think that's not too bad of an hourly rate for us right there. But again, we're going right back to the well on that one until the premium disappears at this level. So that's 200 more bucks. Open door. Keep it rolling with those 5-strike puts. Get back down to 1/4 the size on the total position. I think full size for SoFi and on open door, as we've previously demonstrated, is going to be about 40 contracts. So having 10 contracts right there is about 1/4 size position. But again, that's a 4% ROR on a 1/4 position. So that's the equivalent of a 1% ROR on a full size position, with the added bonus that we have some really nice flexibility. And then the last thing is a short position we have on FFIE, where we're aiming for this to stay below 7.5 for max profit, but we make money as long as it stays below 8 for the coming week. And I'm going to take a sip of water really quickly, and then we're going to talk about our break-even prices, talk about our shopping list for the upcoming week, and then we're going to get into maybe come up with some more trade ideas to add to the shopping list we have right here. All right, that was a really nice sip of water. It tastes a little bit better when you've just been talking by yourself in the corner of your room for 30 minutes straight. Excuse me. But moving on here, our break-even tracker here I think is the best way to conceptualize exactly what kind of cushions we're getting and why we think we derive so much value from the positions that we're in, right? So for a firm, what do we know about a firm? We sold a 22-strike put. We sold it for $1.10. So our break-even price on this individual position is $20.90, meaning as long as the firm stays above $20.90 for the coming week, we're going to make money on the trade. And further, with where it finished on Friday at 23.06, as long as a firm doesn't drop 9.37% this week, we're going to make money on a firm, which is just like a fantastic value proposition. Like, hey, as long as disaster doesn't strike, we're going to make money. DraftKings, we have a really nice cushion right there with the 12.3 rollover price minus the 26 cents of premium, meaning as long as DraftKings finishes above 12.04, we're going to make money on DraftKings. Open door sits at 470 now with a 6.45% cushion. We've got a 9.49% cushion on MSOS, 5.58 on Fubo, and then 6.68 on SoFi. And then since FFIE is a short position, it would need to jump 6.12% or higher for that to be a loss for us. And again, if it does jump higher than that, we could add another spread to the mix and potentially average that price up since it's a short position. These dates are wrong. They should be 7/22. That's what I get for quickly updating the tracker right here. But all in all, that's what we've got headed into the week. Some stocks that we've been playing historically on a week-to-week basis, and stocks that carry some really, really nice premiums to, one, give us some really nice returns, and two, most importantly of all in this volatile and difficult market, give us some really nice cushions that we have illustrated out here in column Q. And again, all of that, and the best way that we think to evaluate potential profit for the coming week, what we term our base profit, quote unquote, is what would happen if the market just didn't move. And if literally nothing moved, all of these prices stayed exactly where they're at as of Friday market close, we're going to take home $3,320, which is going to continue to add to the nice little run that we've been on since the beginning of May, and we get us up to $30,000 of profit since May 8th. So again, we're not trying to hit a home run this week, and I will be upfront and transparent when we do try to hit home runs, because this was a week where we tried to hit a home run and we hit one. It was fantastic. But this week, we don't need to put ourselves in that position, because yes, it's nice to put yourself in a position where if the market goes up, you can make $10,000 in a week. But conversely, there's also a decent level of risk that comes along with that, right? And we saw the RSI on the S&P 500 on a 180-day basis. There's nothing really suggesting to me that we're going to be shooting back up anytime soon. So at 62, I think things are going to be relatively chill. Looks like we might have a strong top at the low 390 area. Definitely a good area to keep an eye on for the 0-day XPX credit spread. I think I will be going bearish with those come Monday morning if we do open green. And it looks like we're well on our way with the futures plus 0.33%. You'd love to see it. However, what we know about futures in our experience is what's going on at 11:07 p.m. Eastern Time could have zero resemblance to what things look like when the market opens tomorrow at 9:30. So we take that with a grain of salt, but always good to see green instead of red. But with that, so we've got 4 names initially off a little bit of research that we've been doing that I think are good to have on the shopping list for the coming week. And what I mean by the shopping list is last week you see all these purple cells because we added trades during the week when we saw a decent opportunity. If we see any particular day next week, Monday, Tuesday, Wednesday, you name it, any day of the week, we are going to have the opportunity to add some stocks at favorable prices, likely with decent premiums, because premium starts to climb a little bit as the market dips. And again, if the market doesn't dip and we never even get to look at this, again, that's going to be about $3,500 of profit for us. That's a good problem to have. But again, we've got ChargePoint, Pinterest, Ford, and Shopify. So let's go down that list one by one and kind of show you what we're looking at. So ChargePoint, CHPT, shout out to Syrian Pony here in the Discord server. He definitely put this one on my radar. 180-day, we're down near this 30-ish on the RSI, which is suggesting it's a little bit oversold. Nowhere near as low as it was back on July 5th when it got down into the red. And again, why do we love RSI? Because it gets down into the blue, and almost immediately after, a decent spike that we can make decent money from. But the 180-day low is about $8.50. I know this stock was a former SPAC, so the $10 price range could be a little bit contentious. At the same time, I do think this is one of the more solid companies that was brought public via SPAC, which unfortunately isn't saying much. But with that said, I think it's good enough for an investment. So if we take a look at what's going on for the coming week, we love the idea of selling a little bit closer to the money, right, with a somewhat smaller position. And you could see 4.5% right at the money. And not just that 4.5, can't speak right now. And it's not just that 4.5% ROR that we like so much. It's the fact that, yes, 11.5 strike is pretty much right where ChargePoint is at 11.57. But we'll remember that it's not just about what our max profit point is. If we sell an 11.5 strike put for about 50 cents of premium, that puts our break-even price down to about $11 a share. And if we go to our handy-dandy chart here over the past 5 days, 11 looks to be a decent little point of support. And again, if it does decide to break down through that, it happens. Whatever, so be it. That's when we add more. That's when we add maybe a 10.5 or a 10 to get our break-even price down to 10.5 and just keep moving the goalposts lower and lower and lower. So that's what we got going right there. I like the idea of ChargePoint. I don't think they have... Do they have earnings coming up soon? Let me double check. Looks like they may be soon, but maybe not immediate here. But the one way we could really check is if we type in CHPT. We go up to CHPT. And you don't really see the blue little notice, so I think it's a little while till they have earnings. So decent one right here. I like the idea of playing it at that level. Moving down the list to Pinterest, which is really, really interesting because there was somewhat of an IV reversion-esque opportunity, but they had a pretty big jump, and I totally hit a key I didn't mean to, PINS. They had a nice little jump last Friday, I think Thursday after hours more specifically is when it was. Yeah, you see this from 1732 up to 2405, falling back down and being surprisingly steady during Friday. And with that spike in the stock, right, you see a little bit of an elevation. It's tough to tell on this 5-day basis. But yeah, you do see a general increase in implied volatility as opposed to where it's recently been trading. If we go to the 1 year, we could verify that potentially. There you have it, right? We've got an IV rank of 93 and an IV percentile of 99%, meaning this is about as high as it has ever been over the historical period. So Consequently, it's a great time to potentially sell options on this stock. And if we go up by the money, we see that 4 point whatever number again, right at the money, which 20 strike, take it down with the 80 cents of premium you get, would give you a 19.20 break even on Pinterest on a weekly basis. However, we go back to that 5-day chart that we opened this discussion with. I don't love the idea of a 19.20 basis, right? Because over the past 5 days, it's not really, there's not really a base there. I can see a base maybe at the 18.5 or maybe at the low 17 level. And if we look at 18.5-ish, or maybe 19, right? You can go 19, still get 2.4%, maybe open a slightly larger position, maybe half-size position, because again, half of 2.4 is 1.2, so you still outperform a full position size with the 1% ROR. But there you go right there. Maybe half a position on the 19 strike to get 50 cents of premium and then get you down to the 1850 level that we feel a little bit more comfortable on. So that's one to keep an eye on. Ford has been solid because I think this is just a solid company that stands to gain a lot of ground in the electric vehicle space. And it is also trading kind of near the lows on a 1-year basis. It did bounce off 1061 back at the beginning of July. So there's a little bit of downside there, but nothing that I'm terribly concerned about, to be honest with you. But again, this isn't one where the premium is going to be knocking it out of the park because it's a nice, well-established company without a ton of price volatility. I know I say that and the chart has it going from 25 to 11. But at this price level, I don't expect things to get too much crazier. We do want to recall, though, that a lot of these stocks are falling back to their pre-COVID highs. That on Ford would be around $9.50 per share. However, if you start selling 11.5 strike puts, there's not a ton we could maybe manage there. Maybe start a little steadier here. But this is a good one because it was up 4.3% on Friday when the market was ripping. So the premium's kind of going to be knocked down a little bit. But when there's a red day in the market, this is definitely a good one to go back to and keep an eye on, which is why we've got it on our shopping list. And fittingly, we have Shop on our shopping list. So if we take a look at Shopify as well, that's another one where the premium, quite frankly, has just been fantastic. We were able to capitalize and grab a few $100 off of it last week. But again, 3-year chart, this is the setup that we like to see, right? Increasing implied volatility over the historical period that we're looking at. It's bottoming back out off a nice base in this 30-ish level. They have some earnings coming up, not this week, but next week. So this really would be a 1-week trade if you took a look at it. But again, right at the money, you've got 4% right at the money. You've got another really, really good number. And maybe if you wanted to be safe with the larger position, you could drop it down below 30 because 30 has demonstrated that it's decent support. And I think anything in that 28, 29 range, if you wanted to go half-size position at like 29.5 for 2.5% ROR, I think that's not too bad of an idea either. We could sell 5 of those contracts. That would pull in $300 of profit. I think that's a smart trade. But again, lots of red candles. There's a green candle every now and then. There was a green candle on Friday. Wait for this thing to come back down and wait for one of those high IV dip days, and that is why it's on the shopping list. So 11:14 p.m., we've been going for about 45 minutes. Let's round out the back end of the stream by going through some of our scans. And I'm going to take one more quick sip of water before we jump into that. So let's start with our favorite scan, which is not just the high ROR puts without earnings, but the high ROR puts without earnings intersected with oversold stocks, right? We like to talk about RSI so much as a leading indicator about short-term performance for a stock. This gives us stocks that have really, really nice options from a premium perspective, but are also at that low RSI level where we could conceivably expect some sort of short-term bounce. So we hit the scan button, we see what happens. We've got 3 names on here: RIG, PSNY, and SLV, a silver ETF, I believe. SLV has the most volume by far on this list with 2,353 contracts traded back on Friday. And I actually took a quick peek at this yesterday when I was doing a little bit of research for you guys. And I like the idea of SLV, which is why I've already got this line drawn in here, right? We talked a little bit a second ago about Shopify getting back and Ford potentially getting back to those pre-COVID levels. And pre-COVID for silver is right around here at this 16, 17, 50-ish level. And there you have it. This ETF is right at 17, 19. I think that's a fantastic place for it to be. And if we go right at the money, it's a 1.22% ROR. And you might say, okay, HT, a 17 strike put on a 17, 19 stock, that's really not that big of a That's really not that big of a cushion. So from there, we would look at the price history, right? It's a silver ETF. This isn't some pre-revenue growth stock, anything crazy like that. It's a commodity that trades a lot more steadily than other stocks in the market. So I think the cushion should consequently be viewed in that manner as well. So I love the idea of potentially getting here. And the bottom of this wick was right at about 1683. And again, if you sold a 17 strike put for 20 cents, that's a 1680 break-even price. So you're below that as well. So 1.22% ROR right there. The one thing about these ETFs is now you're still able to get really, really nice margin privilege, right? So if you sold 10 of these, normally your max loss is $16,800. That's the fully cash secured amount, but it only takes $3,000 of buying power and a $200 return on $3,000 of buying power. When you look at it from a margin perspective, if I can get my system calculator to come on up here. Come on. A $200 return is demonstrated right here, divided by $3,000 of collateral. That's a 6.6% return on capital deployed on the trade. So I love the idea of potentially getting in on SLV. So we're going to go back to our handy dandy profit tracker. Let's type in SLV, and the next rainy day we see in the market, we'll be right back on this list, and we'll be shopping. We'll be scaling into some of these and adding some new names to the list. So SLV is good, and again, that's why we love this scan that we have set up here so much, because it gives us some really, really nice results like SLV. And again, if you go to the RSI, the 3-year RSI that we're looking at right here is 28. It's very, very low. The last time it was this low was literally at the bottom of the COVID crash. So expecting some good stuff in the short term from this one. And if it keeps going down, again, that RSI is going to stay low. You just got to continue to scale in, bank on the pop. But there you go. I'm a pretty big fan. Let me go to the 1 year really quickly to knock COVID out. Yeah, 33 for IV is a little higher than normal, right? IV percentile is 81. But again, IV rank is 38 because it's nowhere near where the IV was back in at the beginning of March. But let's go right back to the scan. PSNY. Do I know what PSNY is? Absolutely not, but we are going to find out together. Polestar Automotive Holding. This is a UK ADR. This looks like it may have just gone public. Let's see what's going on here. 20-day chart. Did it just go public back in June? Let's check the live news for that. It's a SPAC. That makes sense. So it went public via SPAC. I'm not the biggest fan of SPACs right after they become public because we have seen what happens there. And a lot of that risk is priced in here as well. As you can see, 4.49% dead at the money. That's still not even enough to get you back down to 846, which was the low. I mean, maybe keep an eye on this if you're interested in it, but I'm not a big fan. And RSI here, yes, this does come up because it's listed as oversold, but RSI is not the greatest indicator here because the stock really hasn't been trading very long. So every now and then you'll have results like that, but if we go back up here, take a look at RIG, which I imagine is probably some sort of oil stock. Transocean Limited, yeah, this thing has been getting slammed, but again, implied volatility high, RSI low, something's got to give. Let's see what the option chain is looking like. I love the fact that they've got weekly options here. 4.82% right at the money. That's very, very interesting because that 9, 10, 11, 12 cents of premium will get you down to like a 238 break-even price. And over the last year, 232 is the low. So that's not terrible. They've got options at 50-cent intervals. This is one of those risky because of what it is, right? It's a $2.50 stock that's kind of been all over the place a little bit. But in the midst of short-term uncertainty, the one thing that it has demonstrated is some sort of reliable floor around this 270-ish level, which looks like it was breached. But let's get back to 3 years. Let's see what we can see. Yeah, we do see that it does dip pretty sharply below here for the majority of 2020. So because of the downside risk of that, I don't love the trade. If you get in on that one, just know that it's very, very risky, and you have some serious downside right here. And I imagine with these big red candles, something's up right here. Looks like their credit rating is not very good. Price target has been adjusted to 250. Just not a lot going on right here. So yeah, it did come up on the scan as a result, but not a great option. PSNY, not a great option either, but SLV, that's a good trade idea. But now let's knock off the intersection right here, and let's just get the pure results of the highest ROR puts in the market. So we've got this thing sorting in ascending fashion. And again, the reason that we like the intersect feature the intersect feature so much is because when you look at the scan, and sometimes it's a lot more, but for this coming week, we have 662 different stocks that show up on the scan. So adding the intersect feature with any of the personalized stock criteria that we've created really helps narrow down that result and focus on what you really want to get at. But here we go. At the very top of the list is FFIE. That one's been alerted several times in our Discord server as one that is a very, very high volatility trade, and we know that we are in on that one in a short position. But moving down the list, Rev is Revlon. They've already basically declared bankruptcy. GoEV is Canoe, like an electric vehicle company. That was a former SPAC. I mean, definitely not uncommon to have very, very risky stocks at the top of this, because again, at the top of this list, we're still looking at like 5, 6, 7, 8, 10+% ROR, which is an insane number. And what you'll probably love right here is Affirm, right? You can find a company that's a little less risky than some, car vending machine that's about to go bankrupt in GameStop. But again, you find a company that's a little bit better, a lot of ROR, and you start to play those. But we keep going down the list here. JNUG is interesting. It's a leveraged gold ETF. Decent premiums, but again, leveraged ETF. I think the smart money stays away from that one. Fubo's on the list right here, as we can see. We reinitiated our Fubo position at the end of last week. Coinbase is on here as well. I don't hate that idea. Stitch Fix is showing up at 5.5 strike. That's an idea that I might be interested in exploring really quickly here. So let's pull Stitch Fix up. And this one has just been getting absolutely slammed. We have apparently performed analysis on this at a variety of price levels, as evidenced by the really, really busy chart that we pull up right here. This thing peaked at 113.76 back at the beginning of 2021. It is now $5.56 a share. That's crazy. But again, over the past year, gone from 60 down to 466 on the low before bouncing up to 556. We've got this combination here of really, really high implied volatility, slightly oversold. Not quite as low on the RSI as we'd like to see, as evidenced by what we looked at earlier on that intersecting scan. But we go right to the option chain. What can we get here, right? Even at the 5 strike, it's really, really nice. Even at 4.5, you can get 1% ROR. And 4.5, if we go pop open maybe the 10-day chart here, you can get down to the ground floor right here and own Stitch Fix at a price that nobody has owned it at yet. But it's fallen a little bit off the peak of 633. It's settling out a little bit. I love the idea of just like a quick, cheeky little Stitch Fix play right here. Because even if you sell these 5.5 strike puts, again, it's a 5.06% ROR, and if you sell 10 of these, you're pulling a really, really nice number. Let's see what margin looks like. About 50% margin privileges, so your ROC, return on capital, is looking like 10%. But again, both of which, the ROC and ROR on this trade, are phenomenal for a 1-week time frame. And if you do sell the 5.5 strike put, 5.5 minus the 26, 27-ish cents of premium is going to stick you at a 523, 524 cost basis, which is right around here where it's historically been trading for the last 10 days. And the great part about a lot of these trades is, yes, this is like a 1-week outlook on the trade, where, yeah, if it does drop down here, you're stuck with shares potentially at like a low 5s. But it's got high ROR right now, so the odds are that by the time we get to Friday afternoon, it's still going to have some pretty high ROR. So you could turn right around with that 520 basis, sell a 5.5 strike call, or if you want to get really, really conservative, you can sell a 5 strike call, which would be slightly in the money, and this indicates that slightly in the money call options are getting about mid-30s of premium. And all of a sudden, by Friday afternoon, you own Stitch Fix with a basis under $5 a share. And that's how quickly you could manage that position. Let me check the news on this really quickly to see if we've got anything super, super concerning on Stitch Fix. But let's see. We have a director purchasing $1 million of shares. 1 million shares, so $5 million worth of shares at 543. That's very interesting. So a big insider buy right there. That's continuing to be reported on. And hey, if you sell a 5.5 strike put, you're going to own shares at a better price than the director of Stitch Fix, who got his for 543. So I like the idea of Stitch Fix. Let's pop back here and put that one on the shopping list as well. SFIX. There you have it. And let's go back to the scan and see if we could find ourselves one more here as we come up on the hour mark on the stream. SRNE is interesting, but that's another one where I think when you zoom the chart out, there's a lot of downside not even just below the 2.5 or 2 level, but, down potentially below $1 a share. That's one where I don't really like the idea of getting stuck with the risk there. Roblox is definitely a familiar name that we've seen on this before, but that one really, really ran away from us a little bit, and I would hate to chase this thing up around the 40 level just to have it fall back down to 30-ish where it was when it kind of got away from us. So happy to put that one on the side for a second. Keep it in the back of our mind. Absolutely keep it on the watch list, and then kind of go from there. Unity. This is kind of an interesting one right here. I think a lot of people like Unity as an investment. I can guarantee you this is down a very, very significant amount from where it used to be. And again, I guess one broader point to make about this scan, yes, you see some insane names at the top, but when you scroll down to get to this like 3, 4, 5% area, this is kind of where the sweet spot of it is a little bit, right? You start to see some more reputable names. We go down here, we see like Open Door, which is one that we have a position in. We see Upstart, we see, not that that's a great company, but we see Wayfair, Roblox again right there. Where was Unity's first one? Unity right here, right? There you go. But let's take a look at see what it's got going for the upcoming week. Let's back this thing out. Okay, so back on July 8th, this thing was at 46, has fallen back down to 33. So that in and of itself is a pretty big move, and let's slowly just take steps back. 180-day chart right here. This thing peaked at 210. Low post earnings of 29.09. We know since that came up in our no earnings scan that they don't have earnings in the next 10 days, so we don't have to worry about the earnings risk yet. But again, from an RSI perspective, it looks really nice. And again, why do we like RSI so much? Last time this thing was down in the blue, it kind of traded a little flat and rebounded slightly, and we don't need huge bounces. Flat trading is profitable trading for us when we're selling these options. So you can go pretty much dead at the money here, get 4.72%, which is a very, very nice amount. Or we could take the approach we're taking with the firm, potentially start aggressively right here at like 33. Selling a 33 strike put for, $1.22 at premium gives you a 31.80-ish break-even price. And you're going to start the week with the break-even price right around here, 31.80. And again, that's right around the low of last week. And if we extend this to the left and shit really does hit the fan, we have to take the shares at this price. It's a historically nice price, and this lines up very well with some of the bounces that we've seen right here. So I like the idea of potentially maybe having an affirm type trade with Unity. But again, the way that the market moves together, it is one of those things where like if the S&P 500 is down, Affirm, Unity, other stocks typically aren't going to have a mind of their own. They will have a mind of their own sometime, but not all of the time, right? So if one Affirm trade's getting smashed, Unity's probably getting smashed along with it. So that's why we only like to have maybe one or two of these going at a time. And then when the market's getting crushed, we pull a couple of these into the trade. So instead of getting crushed on those new names off the bat, we get really favorable prices on those. And as the market rebounds, the rising tide brings the boat up, and we potentially have a profitable week. But I don't hate the idea of bringing this one into the fold. Let's check the news feed really quickly to see if there have been any recent analyst ratings or targets right here. We've got a downgrade with the price target set at 34, which is a little bit concerning. I don't know if I see it's being, shilled in this little 12 battered stocks that are worth a look article. Let's see. We have a 713 merger article. Share buyback program, which is interesting. They did cut their revenue outlook. That's got to be what that big red candle was. They issued poor guidance. So we've got Citigroup with a $68 price target. That's interesting. We've got a 105 price target, maintaining an outperform. So those two combined with the share buyback, I'm perfectly fine to take on potential ownership of this around the 30-ish level. Premium's nice. I'm throwing this thing on the list and potentially adding some come Monday morning. And again, just to see how this would look from a buying power perspective, if we wanted to sell 5 of these, normally our max loss on that would be about $15,000, but it takes only $3,000 of collateral, and $6,000 return on $3,000 of collateral is like a 20% ROC. That's massive. So I don't hate the idea of running something like that at the beginning of the week as well, just to add another potential, $600-ish into the fray. So I think that's a decent list, right? We have our initial portfolio that's going to be pulling about a 3,000 plus base return. And we have some names on the side where if the market does decide to turn against us, we can scale into those as well and just start to build out that portfolio a little bit. And then the one thing that we really haven't talked about too in depth, because you can't really talk about it in depth because it's kind of a day-to-day thing in the market, are those 0-day SPX spreads, right? Last week we made $1,300 off spreads. The week before that we made $1,100 off spreads. So if you look at our SPX thing over the last 2.5 months, we've made $7,000 off these spreads. They're on fire. So if we have a solid week with spreads, and I think we've been averaging per week about $600-700-ish of profit off of these. So you layer that into our base profit as well, that potentially takes us to $4,000, and that's when we start having a really, really nice week. We potentially see some IV reversion opportunities. We add those as well. We maybe step that base profit up to $5,000-ish. And we just kind of go from there. But that's how you build it out. And it takes a lot to move these things against us, right? We want to move ourselves into a position where we increase the potential base profit. But again, as outlined by the cushions that we see over here in column Q, it is going to take a lot to put us negative. And if it does start going negative, that's when we bring these into the game and make it even harder to turn us negative. Like I think we were briefly negative last week, but what took one green Friday to take us from about break even on the week to a $3,600 profit. So tough to get us red with the approach that we have heading into the week. But even if it does get us red, I think with what we have outlined here, it's very, very easy to get ourselves back into the winner's circle via the position management and addition that we've outlined right here. But with that said, we're just about at the hour mark on the stream. We've got this laid out. Things are going fantastically. I want to have 3 winning weeks in a row, right? We win 10K, 3.6K. Let's try to make some more money again this coming week and head into the back end of June with a huge, huge profit number, right? If this base profit pans out, we're going to be up $17,000 in June with 1 week to go, which is phenomenal. So we're going to aim for that. And again, that's a 12.36% despite just a 1% return in the S&P 500. It's not taking a huge week in the S&P to get us these gains. And I think that's the biggest thing that I can communicate here, right? Even just, the big red ones, we weathered the storm. We wait till the market comes back because the market typically will come back. It's okay. And we're up 12% all of a sudden. These 2 months right here, that's a 14K profit, but that's a 7% dip in the market. You factor May in when it was flat, and all of a sudden between these 3 months, you've got $23,000 of profit, despite a 6% drop in the market. And that's how we're going to continue to execute on this plan to continue our consistent outperformance of the market since we've been publicly tracking these trades in July of 2020. July of 2020. And hopefully we can get that SPY lead up to 3 digits. It's maybe, we have it visualized right here, but maybe better visualized out to the right here where we actually calculate that gap between the S&P 500 and NASDAQ. And as of last Friday, we're up 6.01% on the S&P 500 year to date and up 14.75% on NASDAQ. And back on May 8th, before we began that great week, we were down 14% to the S&P 500 and on 6.37% to NASDAQ. So what we've been doing since May is not only great from a profit perspective, but it's also been fantastic from the perspective of trying to outperform the market, which is our ultimate goal, right? We very well could end up with a loss this year. If it happens, it happens. But if our loss is smaller than the loss of the overall market, I consider us to be winners because we'll have down years. That happens. We're not the type of people who are here to come in front of you and say we're going to turn $1,000 into $1 million and we're going to be driving Lamborghinis around. That's just not a realistic approach to investing. But what we can tell you is that we're going to try to teach you the habits where 1, 3, 5, 10 plus years down the road, you're going to have consistent improvement in the balance of your portfolio and try to accomplish our ultimate goal, which is a goal that eludes tons of professional investors and financial advisors, which is outperforming the S&P 500, which we have crushed it over the past year. And we hope to just continue to build on these cushions. But with that said, we'll sign off with our cheesy little thank you for watching. This has been the Hourglass Trader, where as time passes, we make money, and hopefully we talk again same time next week. And I'm not traveling next weekend, so I finally should be able to do 2 streams in a row. But hopefully we'll talk to you guys same time again next weekend with more money than we have right now. So thank you guys who tuned in. Those of you who are watching the replay, if you're watching the replay on YouTube and made it to this point, good for you too. Appreciate the support. But we'll be in the Discord server all week to talk about our intra-week plays, right? The ones that we have where these are highlighted purple. If you want to join our Discord server, it's free to join the free channels, hourglass-trader.com, and the link is on the homepage of the website. But that's all I got. So thanks for tuning in. We'll see you guys later this week.